Porsche just posted a 98% collapse in profit. Not a struggling budget brand, not a company known for thin margins. This is the single most profitable car maker on the planet, year after year, for 2 decades straight. In 2024, its automotive margin sat at 14.5%, a number most manufacturers only dream about. A year later, that number was 0.3%. That isn't a slowdown. That's a company falling off a cliff in broad daylight, in front of every analyst who covers the industry. Here's the part that should confuse you. Weak car sales barely explain it. Porsche still builds some of the most desirable cars on earth, and people are still lining up to buy them. Waitlists for a new 911 still stretch out for months in most markets. So this isn't a demand story in the way most collapse stories are. The real cause traces back almost 20 years, to a moment when tiny, arrogant Porsche tried to swallow Volkswagen, a company 50 times its size. That takeover failed spectacularly, and in the years since, Porsche has quietly paid for that failure again and again, right up until the moment it handed over its own balance sheet to bankroll its former rival's biggest and riskiest bet on the future. So here's the question this video is going to answer. How did the company that once tried to own Volkswagen end up gutting itself just to keep Volkswagen standing? And why is the bill only coming due right now in 2026, 17 years after the original defeat? Stick around, because the answer involves a hostile takeover, a debt trap, and a decision made in 2022 that quietly set all of this in motion, and it says something bigger about what's happening across the entire German auto industry right now. To understand how far Porsche fell, you first need to see how high it climbed. In 1993, the company was on the edge of collapse, losing roughly $150 million a year, with analysts openly debating whether it would survive the decade. That year, a new leader named Wendelin Wiedeking took over, and he rebuilt the company from the ground up. He tightened production lines, slashed waste, and turned Porsche into the most profitable car maker per vehicle sold anywhere in the world. By the mid-2000s, Porsche was selling a fraction of what Volkswagen sold, something like 1/50th the volume, and yet it ran circles around VW on margin. Think of it like a small boutique workshop out-earning a massive factory floor simply because every single unit it sold carried enormous profit built into the price. Sports cars like the 911 and the Carrera GT weren't just halo products for car magazines, they were cash machines. Wiedeking became the highest-paid executive in Germany, and his old contract famously included a profit-sharing bonus that nobody thought would ever matter back when the company was hemorrhaging money every quarter. By 2022, years later, Porsche would go on to produce over 300,000 vehicles in a single year, a record, and bankers pitching its eventual stock listing would compare it to Ferrari and Louis Vuitton in the same breath. A luxury brand first and a car maker second. This is the version of Porsche you need to hold on to for this story. Small, supremely confident, and stunningly profitable. A company so sure of its own execution that its leadership looked at Volkswagen, a giant 50 times its size, and saw something worth owning outright rather than something worth partnering with. If you want to see exactly how a company that small set its sights on a company that big, stick around, because what happens next is one of the boldest financial plays in automotive history, and if collapse stories like this are your thing, subscribe now, because we tell the stories the financial press moves past too quickly to actually explain properly. Starting in 2005, Porsche quietly began buying up shares and stock options in Volkswagen. Publicly, executives denied any takeover ambition for years, insisting the stake was purely protective. Privately, the position kept growing, month after month, deal after deal, option contract after option contract. By October 2008, Porsche revealed it controlled roughly 74% of Volkswagen through a mix of direct shares and derivative contracts, a stake most of the market had no idea existed. The reveal set off chaos across financial markets. Hedge funds had bet heavily against Volkswagen stock, assuming shares had already climbed too high to keep rising. Some of those funds had borrowed VW shares to sell them, betting they could buy them back cheaper later. When Porsche's true position became public, there weren't enough real shares left on the open market to cover those bets. Short sellers scrambled to buy at any price, and Volkswagen's share price briefly rocketed past €1,000. For a few surreal days, Volkswagen was the most valuable company on earth by market value, purely as a side effect of a squeeze nobody outside Porsche saw coming, one that reportedly cost short sellers tens of billions of dollars combined. Porsche wasn't really behaving like a car maker anymore. The BBC later described the company as a hedge fund with a car company attached, and that framing wasn't far off. By some accounts, Porsche had made more money trading options on Volkswagen stock that year than it had made building sports cars, which tells you everything about where its priorities had drifted. Wiedeking stood on the edge of completing one of the most audacious takeovers in European corporate history. Volkswagen, 50 times his company's size, was finally within reach, just a few percentage points away from total control. It would have been, by a wide margin, one of the largest reversals of scale in the history of the auto industry, a company with a few thousand employees effectively running one that employed hundreds of thousands. But that's where things get interesting, because completing the deal meant clearing one more hurdle, a regional government's veto power buried inside German law. And clearing that hurdle meant Porsche had taken on a mountain of debt at exactly the worst possible moment in modern financial history. To push its Volkswagen stake past the required threshold and toward the 80% needed to override a lingering state veto, Porsche had borrowed aggressively, running up roughly €13 billion in debt. That veto existed because of what's known as the Volkswagen Law, a rule dating back decades that gave the state of Lower Saxony outsized blocking power over the company regardless of how many shares anyone else owned. EU courts had actually ruled the law illegal back in 2007, but German lawmakers found workarounds, and Lower Saxony's own governor, Christian Wulff, quietly pushed Chancellor Angela Merkel to help keep it in place. Think of the Volkswagen law like a locked gate that no amount of stock buying alone could open. Porsche could own the whole building and still not hold the keys. Then, in the fall of 2008, the global financial crisis hit, and credit markets froze almost overnight. Banks that had happily financed Porsche's stock buying spree suddenly wanted their money back. Fast. Wiedeking later said he had been blindsided by what he called draconian lenders, but the underlying math was simple and unforgiving. Porsche now owed billions it could not refinance, and its collateral was tied up in Volkswagen shares it still didn't fully control. At the same time, longtime Volkswagen chairman Ferdinand Piëch, who had spent years appearing to step back from power, reasserted himself completely. According to reporting on the saga, Piëch began publicly questioning Wiedeking's leadership just as the debt crisis peaked, and he began quietly pushing an entirely different idea, that Volkswagen, not Porsche, should be the one doing the acquiring. Porsche's own weapon, its aggressive and secretive stock strategy, had become the exact thing now being used against it. The hunter had run out of ammunition at the worst conceivable moment, and the target was about to become the buyer instead. Everything Wiedeking had built his reputation on, speed, aggression and financial cleverness, was now working entirely against him. By July 2009, Wiedeking was gone. He resigned with a severance reported at roughly $71 million, a payout that looked less like a retirement gift and more like the price of clearing a path for what came next. That fall, Volkswagen agreed to acquire Porsche's entire automotive business outright for $11.3 billion in cash, paid out in stages for tax reasons. The company that had tried to buy Volkswagen was now, in every meaningful sense, owned by it. Qatar's sovereign wealth fund stepped in during the crisis to help stabilise the position and absorb some of the debt exposure, eventually becoming a long-term shareholder across both companies. What remained of the old Porsche empire got folded into a new holding company called Porsche SE, which to this day doesn't build a single car. It exists purely to hold a stake in Volkswagen and collect dividends, run by the very same Porsche and Piëch family that had just watched its takeover dream collapse. The actual Porsche brand, the 911s, the Cayennes, the racing pedigree that took decades to build, became a Volkswagen subsidiary in every sense that mattered, operating for years under a formal domination agreement that let Volkswagen absorb Porsche's profits and losses directly. Here's the part worth sitting with for a moment. Porsche didn't just lose a takeover battle, it lost its independence entirely, becoming one asset inside the much larger machine it had once tried to own outright and control from the top down. The engineers kept building cars, The brand kept its name over the factory gates, but the decisions that mattered most, capital allocation, strategy, direction, now belonged to someone else's boardroom. Keep that in mind, because 13 years later, Porsche would give up its independence again, in a completely different disguise, and this time nobody forced its hand. It volunteered. Through the 2000s and into the early 2020s, Porsche quietly became Volkswagen's single most valuable asset. As a subsidiary, it consistently posted the group's best margins by far, effectively subsidizing weaker, lower-margin brands like Seat and 7 other lines across the entire portfolio. Then, in 2022, Volkswagen made an unusual move. It took Porsche public again, floating 12.5% of the company on the Frankfurt Stock Exchange in a deal ultimately worth around €9.2 billion, one of the largest listings Europe had seen in over a decade. Here's the detail that defines this entire story. Every single euro of that IPO went straight to Volkswagen, not to Porsche itself. According to Volkswagen's own statements at the time, the proceeds were earmarked specifically to fund VW's electric vehicle expansion, its software division, and its broader technology ambitions. Porsche's brand value, its scarcity, its decades of engineering credibility, all of it got monetized to bankroll its parent company's most expensive and uncertain gamble. The structure was carefully built too. The public got non-voting preferred shares, cornerstone investors like Qatar's sovereign fund, Norway's central bank, and asset manager T. Rowe Price took chunks of that stake, and the Porsche and Piëch family bought a blocking minority of voting shares using debt and a special VW dividend. Within days of the listing, Porsche's own market value briefly exceeded Volkswagen's entire market cap, over €83 billion against roughly €78 billion. The subsidiary was now nominally worth more than the parent that owned it, at least on paper. Oliver Blume, already Porsche's chief executive, was named Volkswagen Group CEO that same year, running both companies at once, a dual role investors questioned from day one. Porsche had sold its soul once by losing a takeover fight. Now it was doing it again, by choice, cashing in its own credibility to keep Volkswagen's electric ambitions funded. That decision was about to force Porsche's hand on something far bigger than a stock listing. Because once Porsche's capital had gone toward funding Volkswagen's electric future, Porsche needed to prove that future belonged to it too. The future of Porsche is electric, Blume said at the time, laying out a target of more than 80% fully electric new vehicles by 2030. The company poured billions into a next-generation EV-only platform and even explored building its own solid-state batteries in-house, chasing a technology most rivals hadn't even attempted yet. The bigger problem wasn't the spending itself. It was the assumption sitting underneath it that Porsche's buyers wanted the same electric future Volkswagen was betting the whole group on. They didn't, not at anywhere near the promised pace. The Taycan, Porsche's flagship EV, dropped from a peak of 41,296 deliveries in 2021 to just 16,339 in 2025, a fall of roughly 60%. Along the way, the Taycan also drew multiple battery-related recalls, and reports of vehicles catching fire in China did nothing to help buyer confidence. China, the market Porsche expected to lead global EV growth, instead became the market where domestic manufacturers started beating European brands on both technology and price, in the exact segment Porsche had staked its future on. On paper, the all-electric pivot looked like leadership, staying ahead of a shifting industry before rivals caught up. It wasn't. By September 2025, Porsche was forced to slash its own medium-term profit targets, cutting expected margins from a range of 15 to 17% down to 10 to 15%, and admitting its EV-only platform no longer made financial sense. It reversed course entirely, scrapping that platform and shifting back toward combustion engines and plug-in hybrids for its Panamera and Cayenne lines, in some cases stretching that timeline into the 2030s. Reversing a bet that size doesn't happen quietly, and it doesn't happen for free. It shows up on the balance sheet all at once, in a single brutal accounting hit, and what came next was ugly. Porsche booked roughly €4.7 billion in write-downs tied directly to the EV reversal. €2.7 billion of that was a straight goodwill impairment. the marked-down value of Porsche's own future, sitting quietly on Volkswagen's books. The result: automotive operating profit fell from €5.3 billion to just 90 million, a 98% collapse in a single year. Including financial services, full-year profit fell from 5.6 billion to 413 million, down more than 92%. Global deliveries dropped roughly 10%, landing at around 279,000 vehicles. Revenue fell nearly 12%. The stock told the same story. Priced at €82.50 at IPO, Porsche shares sank as low as €36.50 in early 2026. A decline of roughly 58% from the day it went public. Every investor who bought in at the top, including the sovereign wealth funds VW had courted so carefully, watched more than half their money disappear. In September 2025, Porsche got demoted out of Germany's benchmark DAX index entirely, dropping into the second-tier MDAX on falling market value. Volkswagen felt every bit of it too. Group operating profit fell 53% to €8.9 billion. Net profit dropped 44%, the weakest result since the diesel scandal a decade earlier. We increased our market share slightly despite increased Chinese competition, VW's chief financial officer Arno Antlitz said, in what counted as good news that year. Volkswagen announced plans to cut 50,000 jobs in Germany by 2030, targeting margins back up to 8 to 10% by then. Porsche itself confirmed roughly 3,900 job reductions of its own. For 2026, Volkswagen is guiding toward an operating margin of only 4 to 5.5%, an improvement from 2025's 2.8%, but still well below the 5.9% it posted back in 2024 before any of this hit. Under mounting pressure over holding two CEO chairs simultaneously, with Volkswagen's own works council publicly calling for him to give one up, Bloom brought in someone new to run daily operations. Michael Lieters took over as Porsche's CEO on January 1st, 2026, delivering his first annual results 10 weeks later with a 3-word mission statement: leaner, faster, more desirable. So what actually went wrong here? It comes down to 3 decisions. First, in 2009, a failed takeover stripped Porsche of its independence entirely, turning it into a subsidiary of the very company it once tried to own outright, with Volkswagen absorbing its profits directly through a domination agreement. Second, in 2022, Porsche let itself become Volkswagen's fundraising vehicle, floating shares specifically to bankroll its parent's electric ambitions instead of its own future. Third, having taken that money, Porsche felt obligated to chase Volkswagen's electric timeline rather than its own customers' actual demand. And that final bet is what finally broke the numbers wide open. Porsche didn't collapse because sports cars stopped selling. The 911 remains one of the most desirable cars on the planet, waitlists and all. It collapsed because, twice, at 2 very different moments 20 years apart, it traded control of its own direction for someone else's survival. In 2009, that trade was forced by debt and politics. In 2022, it was a choice made willingly, in broad daylight, with bankers and cornerstone investors cheering it on. Whether Michael Lieters can actually make the brand leaner, faster and desirable again remains a genuinely open question, one that will play out over the next several earnings cycles, not the next one. Bloom himself has admitted the company is now operating in what he called a fundamentally different environment, one that demands a very different playbook than the one Porsche built its reputation on. But Porsche isn't the only crown jewel quietly propping up a struggling giant. Next time, we're looking at the other Volkswagen brand carrying the group's profits right now, and asking exactly how much longer that arrangement can hold before it cracks too.